Right, can anyone hear me? Cheers, Tom. Right, I guess we'll wait just a few more minutes, I guess, just to see if other people come. I'll send a little reminder into the chat. Right. Oh, fucking up for people. It's always a good start.
Hello.
Are you, Mark?
Yeah, I mean, brilliant. Thanks, guys. Sorry, I was having some technical problems.
No worries. Happens to the best of us. Well, I'll give it another minute, I think. That's 5 minutes.
How's everyone doing?
Yeah, not bad, mate. Not bad. Good day?
Yeah, not bad. Not bad. Yeah, so not bad at all.
Oh, can you hear me?
Yeah.
Yeah.
Wicked.
Oh, I've got Mr. Worldwide joining.
What time was this meant to start at?
6.
I thought for some reason it was way later. Way earlier.
No, because I was gonna do it earlier, but then with people working and stuff, I think a ton of people couldn't make it, so I just thought I'd push it back.
Yeah, I'll only be able to join for about 15, 20 or so.
Oh, that's fine. Right, in which 5 past. Right, can everyone see my screen?
Yes.
Great stuff. Right, lovely. Oh shit, I can't see if there's people who need to get into the thing. Right.
A gift just showing up.
Okay, so introduction to options. So I don't know, I'm not going to assume any knowledge, just see if we go from like a complete beginner level and just kind of work through stuff and see what sticks, see what doesn't. If there's any like questions that come up, or anything like burning, just shout out, and obviously do my best. If I'm explaining something shit, just tell me and I'll go back over it and everything, and we'll see what can be done.
Sorry, could you go back over that, mate?
Yeah, of course. Mate. So, if I'm explaining something shit, just tell me I'm explaining it shit, and we'll do that again. Oh, okay, so introduction. So, what are options? Options are derivative contracts, so much like a future or forward, but they provide the buyer the opportunity to buy or sell, depending on the type of contract, if it's a call or if it's a put. And they allow the buyer the option to buy or sell the underlying asset. But unlike futures, the holder of the option is not required to buy or sell or consume in the market if they choose not to, if the price that they've chosen to participate at is unfavourable at the time. So call options let you buy, or they allow the holder to buy the asset at a set strike or a set price within a certain frame of time. So it could be a week, could be a month, a year, 5 years, 10 years, and on and on. Put options do the opposite. So they allow the holder to sell the asset at the stated price within that time frame. On the other hand, the seller of the option is obligated to act if they're requested to do so. So if the contract, the option contract, is at a favourable point for the holder at expiration, then they can assign or instruct the seller to buy or sell their particular underlying at that set strike. So 2 main reasons to be in options. Oh, bit of echo. That's all right now. So 2 main reasons to trade in options over anything else, or rather sort of linear contracts, is the they're quite flexible. So they're a flexible way to manage exposure to an underlying. And so typically you'd be looking at this style of exposure if you are hedging. But then at the same time, they provide sort of really decent, they can provide a ton of gearing or leverage to people who want to speculate in a market. And for those people who want to have a defined risk alternative, so where you know what your max loss, potentially your max gain is going to be before you even press go on the thing. So options then provide a certain benefit that sort of outright long or short contracts don't. So you've got that potentially lower cost of entry, the potential for a much higher return on invested capital. So option prices can be multiples higher than the premium that you've initially paid if the price moves favorably in a direction for you. And then again, you can structure a trade that has a potential for less risk. So you can have that defined risk strategy. So for example, if you buy just an option, if you buy a call, say, you know your max loss is just the premium paid. You can't use anything more than that. So as we said before, calls are the agreement that give the buyer the right but not obligation to buy the underlying asset, so they can walk away from the contract. And the call buyer profits when the underlying asset goes up in price. So of course you're buying the right to buy. So you want to buy at a cheap price and sell at a higher price. Buy low, sell high. At least that's what you try and do. And then options are the opposites. They give the buyer the right but not obligation to sell the asset. So again, you're looking to sell high, buy back those shares lower. So of course the put buyer profits when the underlying decreases in price. So there are a few types of vanilla options, which today, well, we're just going to cover what a European option is and look at the different dynamics behind it. So European options are options that can only be exercised at expiration. So what that means is that over the course of the option's life, even though the strike price might end up being above or below the actual underlying price, if it's a put or a call, which might be favourable for exercise, you can't do it right until the very end of the contract on the exercise date. But American options are different in that sense that they give you the ability to exercise at any time over the life of the option. So you can really, there's some advantages to that. And obviously, if anyone's got like questions as to the difference,
Sorry, still sell the option though. Say a European option, you can't exercise it, but can you sell it on an exchange?
Say that again. Sorry, it went a bit funny.
Can you hear me now?
Yeah.
Yeah. So you can't exercise a European option, but can you sell it? So could you sell the option?
Yeah, of course. So you can,
Okay.
you'll be able to sell it on before the expiration date. And so really what you tend to find is that in 99 out of 100 cases, that's a more favourable alternative than to... So that you'll find that selling that option on, once the prices move favourably in your direction, selling that option is better than actually exercising because of time value, which we'll come on to. So an Asian option then is slightly different, and it's basically the payoff is determined by the average price of the underlying over a predetermined period. So it's a bit more mathsy. I don't know if they were trying to be a bit sneaky by calling it an Asian option, but it's basically to do with the average price over the life instead of just the expiration price or the interim price. And then barrier options are the ones that they're basically, it's almost like a light switch. So price must or must not pass a certain level. So if it's a knock-in or knockout option before it can be exercised, so it has this kind of built-in light switch that passes a certain level, the light switch is on, and it becomes like a regular European option. So and then binary options are the ones that you get scammed on, and you know there'll be a bloke with a Lamborghini, maybe like some girls that he's hired for the day, and he'll be like, oh, you can make millions on these binary options, but really they're kind of a bit more complex, and so typically you don't find them on exchanges. They're more sort of OTC style, which again is, especially when you're dealing with like these scammers, can be a bad thing, a very bad thing. And then exotic options are this kind of large category of things that are just like complex financial structures. So the payoffs might be like a combination of an option with a different type of option, all these kind of different structured products that you can think up of, and the quant desks like work overnight to hedge and create these weird payoffs that only click at a certain time. So those are very sort of complicated. I don't fully understand them, but there is a big world out there for those exotic stuff. Right, so the cost of buying, so it's this premium. So obviously the right to buy, but not the obligation, doesn't come without cost. And so when you purchase an option, whether it's a call or a put, the buyer of the option is paying that premium, and that is debited from their account when they purchase it. But of course, the mark-to-market interim value, they don't lose that premium straight away because they can sell the option on. But the premium is determined by a number of factors. So obviously the spot price or the forward price of the asset, how volatile the underlying asset is, the time to expiry, of course, is a big one. Strike price, incredibly important, of course, and then your interest rate. So what rate you can borrow at and what rate you can lend at. Because those are two different things, as we're all aware. So obviously we're all familiar with a typical P&L curve of just outright positions. So obviously here we've got a long position in the underlying on the left and a short on the right. And of course there's no difference. It's completely symmetrical either side of that x-axis. There's no difference whether you lose less money on one side or you gain more money on one side. It's just one for one, completely symmetrical. And the steepness is of course determined by how many contracts you've got on. But a call is slightly different, or quite different, shall I say. So you're owning the right to buy. And so just for this example here, we'll say we've got the 100 strike call. And we can see that our payoff is, so this is, just so no one gets confused here, this payoff is assuming no premium paid scenario. This is just looking at just the pure payoff. No premium is deducted. So we'll see later what a break-even chart would look like, but just for the sort of conceptual sake, this is what these payoffs look like. So the payoff for a call is the maximum of 0, or the stock price minus the strike price. So you can see here that at about $5 or 105 in the underlying, you make, I mean, there should be both be dollars or both be pounds, but it doesn't matter. You make about five units of currency. And so yeah, so say you're at 5, that's what you make instead of 0. But if you're down here, it doesn't matter how far below 100 you go, you won't lose more than 0. You just walk away. And then a put is completely the opposite. So it's just flipped around. You make money when the price goes down, and that payoff structure is exactly the same, except that the payoff maximum is now the max of 0 or strike price minus stock price. So it's just flipped those two variables to account for the direction that you're hoping for the underlying to move in. And then a short call is just the reverse of the long call, where it's flipped about the x-axis. And you can see that, well, you lose money as the price goes up, and your payoff is completely just the inverse of what the long call is. But you see that even though this chart might look confusing, you'd be like, why would I ever sell a call? Of course, it's just important to remember that these things demand a price. There's different advantages as to when you sell, or these different conditions that have to be met to actually sell. But now the payoff is the other way around. So it's the minimum of 0, or the stock price minus strike price. So if it's at 95, the underlying, then you make 0. And then the short put is the other way around. Again, it's just the long put, but flipped. And you make money as the price rises, and of course you lose money as the price falls. Okay, so those were just the sort of basic payoffs at expiration, so assuming no premium paid. But when you add time in, and this is kind of the key factor, time, when you add in that time, everything sort of changes. So we'll look at the similar positions, but with so same underlying asset, but we're going to assume different times to expiration, different implied vols, and then a 0 carry, so 0 rate, 0 dividend, and we'll see how those look. So this is the long call, struck at 105, so the strike is 105, and with 30 days to expiration. So you could see that you've got these different lines. So of course, last time we were looking at just this kinked grey line down the bottom, but now you've got these curved lines up here. So you can see that the blue line represents the P&L today. So if the price was to move up and down today, that's the path it would follow, assuming no change in volatility. But just through spot, that's how that would look. And then you can see if you weren't to move, if we were to stay at 100, then you would fall down to this orange line. So you lose money. And then, of course, you lose even more money if as time passes. So for no movement, your P&L gets chipped away, and that value of the option is decreasing over time, is decaying. But the key concept here really is to understand that this curve, or this line, this profit line, isn't straight. It's not linear. I mean, it's linear up here as you approach deep inside the money. It becomes linear, becomes delta 1, so to speak, because the delta does tend to 1. But here it's curved, and what that's illustrating is this concept of convexity. Mathematically, convexity is just a positive second derivative. So if you were to differentiate this line and then differentiate it again, so to find the rate of change of this line and then to find the rate of change again, it would be positive. And really, all that's saying is that as you move down here, but you get less long, and as you move up in price, you become more long. And this battle between time value and convexity is really what you're paying for. And that's one of the sort of key concepts of options, is that they provide these convex payoffs, but you pay for that convexity, for that sort of obligation, or sorry, the lack of obligation with time decay. Because you can see down here, as you approach lower prices, your P&L is nothing. Well, it's minus 64 cents. So we'll look at the next one at 365 days. Obviously, you're paying a lot more, so $5.90 versus 64 cents. And you can also see that this x-axis is a much wider. So this P&L is changing over a much longer time frame, or not time frame rather, but price frame, I suppose would be the right word. So yeah, and same thing again. You so obviously you see the premium is more. Time erodes the value in a similar sort of fashion. But you can also see these. I mean, these are have a same amount of days between them. It's about 160 odd days. But what you see is that this change, this relative change here, is different. So basically what you can tell is that as time passes, you pay more in time decay. But likewise, the more you lose from that time decay, remember this trade-off between time decay and convexity, you gain more convexity because your P&L here is more curved. So it curves upwards, so you become even longer, even quicker down here as time passes, and it goes to zero just like that. And we'll see that a bit later on with the 7-day option, how that looks. So 30-day option with the 95 put, it's pretty much the same thing as the call. But what you can note is that the put is cheaper than the call, even though they're both $5 away from the spot price. And I'll leave you to sort of think about that and what that might be implying in terms of the model, and what the model may be trying to say, what it's trying to get at with that. But yeah, so you can see it's slightly different between puts and calls, but the payoff is much the same. So we look at this 7-day put here at 95. It costs 3 cents, but we look at that 30-day put, it costs 57 cents. So you note how this option, even though it's got 7 days to expiry, is 19 times cheaper than that 30-day put, even though it's got 4.3 times the number of days left. So again, it makes you think about that accelerating time decay as time passes. But again, you're offsetting that with increased convexity. So hopefully those charts all made sense, and you can see the difference when you start adding in time, how you have that curved payoff line. So yeah, so we can sort of intuitively see that option price and value is made of 2 different parts. So you have these 2 parts of intrinsic value and time value. So time value is the amount of time left to expiration, of course. And then intrinsic value is the amount that the underlying is above or below the strike of the call or put, respectively. So just an example, if you take that 100 strike call on ABC, trading at 100, it still has a price. Even though if you were to exercise that today, if it was an American option, for example, you would gain nothing from it. In fact, you'd lose because you've paid the premium for that option, and I'm sure you've incurred interest costs along the way as well. So there's still a price for an option, even when there's no intrinsic value. It's not like you can go out and buy the 99 call, the 101 call for free. It still has a price. It'd be less than the 100 call, but there's still a price to it, and that is purely time value. And so we can look here and say that intrinsic value is just quite basic. It's stock price minus strike price. So it's the amount above or below. And in this case, there's no intrinsic value. But then time value is that remainder, the remainder of the value left over. So quite simply, you can see it's market value minus the intrinsic value. So £3.50 or $3.50 rather. And just from that, kind of conceptually, a point that can be made is that at the money options are entirely made of time value, and they are the options with the most time value as well. If you move either way to the right or to the left of the strike, you have less time value. So it's just something that you can look at to see. You can say at the money options are made entirely of time value, and they have the most time value of any option. So we've got to think about pricing options, like what is the correct price for this potential obligation that I'll have to, well, if you're the seller, that obligation to buy or sell the underlying, depending on whether it's a put or a call. So we can just look at some basic inputs to our model. Obviously, we've got the underlying price, the strike price, the number of days till expiration, our carry costs if they're applicable. So obviously, if you're dealing in a zero rate environment or in futures, there's no interest rates, there's no dividend yields, so that isn't applicable. But then the key one, because all these top four here, these are all kind of observable in the market, but this volatility input isn't, and it's because you're forecasting. So this volatility input is the expected standard deviation of the underlying price over the life of the option, so over the days till expiration. So we just look back at like some famous pricing models, or some ones that are sort of paved the way, so to speak. So if we look back in 6th century BC in ancient Greece, a bloke called Thales, he bought a call option, or it was basically a very similar structure to a call option on the use of some blokes' olive presses, I think. But he basically said, "Oh, I'd like to. What price can I pay to have the possibility to use these presses over the coming months? Because I think the harvest will be better than expected." And they paid a price, and it worked out for him. So, good job him. And then we fast forward a few years to 1900 AD this time, not BC, and we find the Bachelier model, which is used in interest rate options. You may, back in April, May time, you probably would have heard this name flying around, because it's basically allows you to price options with the underlying trading at a negative price, because obviously we have negative interest rates now. So how can we deal with that? Because standard models don't really deal with negative prices, but when crude oil traded negative, people were like, how am I going to price my options that are trading at a negative price? The answer
wasn't Bloomberg unable to do that?
Yeah, Chris, they took ages. I know Hugh was ranting about it for a while. Like they came back a month later saying, "Oh, yeah, we've got it now," but it's way too late by that point. So that's a useful model, Bachelier, for negative prices if we come across those again. But again, used in the interest rate option market today. 73 years later, we come across Black-Scholes Merton. So Fisher Black, Myron Scholes, and Robert Merton created this model, which essentially took a number of assumptions, some unrealistic, but put them together to create this option that prices these options in a different style of world, sort of the world of risk neutrality, where essentially there's no arbitrage can exist, and so the expected return on a riskless instrument is just the risk-free rate, and basing your prices around that model or around that idea, that comes up with a price, and it spits out the option price based on a number of other assumptions and inputs, but that's what it comes out with. So it is a brilliant model, and it's very elegant, but the assumptions are flawed. But because it's such a good model, you're able to overcome the flawed assumptions inside it. And so the biggest example of that would be the skew that you can observe if you look at any option chain. No option has the same implied volatility. Well, some do, but if you look out across different prices, depending on the instrument you're looking at, it has a different volatility, which goes directly against, and it flies in the face of that assumption of Black-Scholes of a constant volatility. And then a few years later, the binomial tree model came out from Cox, Ross, and Rubinstein. Try and say that 5 times fast, doesn't work well. It basically prices based on a binomial tree. So you have an option, the underlying price. It can go in 2 different ways, in 2 different sort of branch-like manners, and it branches out and out and out. And what's quite cool about this model is that if you run it over where the time period is infinitesimal, so it's an infinitely small time period, it does converge to the Black-Scholes value that Black-Scholes gives. So quite cool in that sense. And then more recently, it's basically looking at how can you price volatility in a better, more realistic fashion. So we've come up with sort of local volatility models, stochastic volatility, which essentially model the behavior of vol because it's not constant. So what's the best way that we can go about doing that? And different models give different results and reasons and assumptions behind it, but some include Heston model, the Sabre model, and Garch. So those are all ones that you can search up, and they're quite interesting applications to volatility pricing. But just because Black-Scholes is so convenient, we'll just focus on this one. So I won't delve into the formula, but this is the price of a European call is given by these assumptions. So, or not these assumptions, but this equation. So European call is the stock price, or the present value of the stock price times the cumulative normal distribution function of D1, where D1 is this log of stock price over strike price, plus R minus Q, which are your carry considerations, plus half the variance times time to expiration divided by this volatility or standard deviation times the square root of time. And then minus, again, the present value of the strike times ND2. So again, we're looking at this thing that the volatility is this unknown input. And I have stolen this directly from MacroHedge actually, but volatility is this unknown input. So you can put in an expected volatility and spit out a theoretical value for your option price. But likewise, you can take the market price of an option and back out to the implied vol. So quite a common way of pricing or quoting rather option values is via an IV because it is more stable. Yeah.
Sorry, Joe, is this just on European options, or can you do this on American options as well?
This is any option. So looking at American as well, again, it's this Black-Scholes. We're just using Black-Scholes for the moment, but it's this unknown value because, of course, all the other inputs of stock price, strike price, days to expiration, and those carry considerations, those are all directly observable in the market. So the one big unknown is vol because it's forecasting. Oh, great, thank you, Zoom. So it's this unknown variable that is just kind of you have to predict it, and so you have an implied volatility given by the price at the market, and that is essentially what the correct volatility would be to get that market price. When you take that price and compare it against all the Black-Scholes model, what's the price come out as? And so you'll see in equity markets, of course, you have the skew where puts trade at a premium to the calls in terms of volatility. So puts trade at a higher vol compared to the calls. But across different assets, so today I was looking at soybeans, they have this really wonky sort of skew, which kind of is down on the puts, kind of comes up and then back down and then back up again on the calls. It's really weird. But yeah, so it's essentially saying, what is my expected volatility over the life of the option? That give me a value. If I disagree with that, then I can go into the market and buy or sell because I think volatility will be higher or lower depending on the price of the option and my forecast of vol. So it's really this big unknown quantity that is the sort of source of so much debate and is the big thing, the big unknown as well. So what is vol? So consider two assets over time, asset A in the orange and B in the grey. Which one is more volatile? And I think it's quite clear that B is, right. It's moving around way more, and that's on purpose because I did make it more volatile. So you can see that the asset B has 124% standard deviation, and option asset A has a 31% volatility. So a different standard deviation gives rise to sort of different movements as well. And that's just a neat sort of visual representation of what does a larger standard deviation mean in terms of movement of an asset. And volatility is just this annualized standard deviation. And this annualization factor comes in because basically in Black-Scholes, one of the assumptions of the way price moves is called geometric Brownian motion. It's essentially randomness, but is geometric. So it's a multiplier rather than arithmetic where it's adding on. So one of the assumptions of that, or not assumption, but one of the key points about that is that variance, which is the volatility squared or standard deviation squared, moves directly proportional to time. And so you want to see how volatility moves in relation to time, and it moves proportional to the square root manner. So because when you square root variance, it spits out standard deviation, and when you take the square root of that entire sort of variance times time sum, it comes out with standard deviation times the square root of time. So that's how you can evolve volatility over time, but that's what this annualized figure means. So you could take a daily volatility or a daily standard deviation of 1%, and if you wanted to times that through by the number of business days in the trading year, it would be 252, which is roughly 16. Or sorry, rather, the square root of 252 is roughly 16. So you would take that 1% move and times it by the square root of 252, and it's about 16. So it would be a 16% annualized standard deviation. So we can price those options on those different assets. So looking at A with the 31% vol and B with the 124% vol, same strike, same days to expiration, and zero carry as well. You can see that A will cost you 354, but B will cost you 1411, and that's because B has a greater chance of expiring within the money because there's so much movement. It ought to cost more. It ought to cost more money because there's a greater chance, because it's got higher movement, that it can finish up in the money with some intrinsic value at expiration. So you pay a premium for that. But then we can just look at the scales, because 124 divided by 31 is 4. But when we divide these prices through, we can go 14.11 over 354. It's just under 4. So you can infer that these at the money prices scale almost linearly with volatility, but not quite. And it's not important for now, but it is a sort of concept that you can look at and probe a bit more, because it's one of these artifacts of Black-Scholes. So I think looking at standard deviation as an expected move, if you're sort of newer to this whole sort of realm, I found it not particularly intuitive to think, I don't know how much it's going to move, especially an annualized figure, because it doesn't really mean much. It means how much do I expect the asset to be within a range of 68% of the time over the course of a year. Oh, that's great, but how much does it need to move each day for it to be at that level? So what's quite lucky is that it's quite it works out quite neat, the sort of formula. I won't go into the maths, or I can if people want me to, but essentially you just divide the implied vol by 20, and that will give you your expected daily move up or down. So an IV of 60. Oh, I see Tim's wanting to join us. Yeah, so an IV of 60 will translate to an expected daily move of plus minus 3%. So you're expecting day to day over the course of the week that asset will have to move up 3%, down 3% over the course of the day. So that absolute move will be about 3%, and that's what it has to be to justify that volatility of 60%. And so what's quite good is that we can use this scaling factor of 20 to see if vol is rich or cheap compared to recent realized vol. And there's different tools out there that will model or kind of adjust and show you implied vol and then realized vol at the same time with a time lag to see if the IV is rich or cheap or about right. And normally what you find is IV runs in normal times, in sort of calm times. It runs slightly hot. It runs just over realized vol. So there's sort of a premium in there that's sort of baked in. But when you see massive moves, so back in March, in early March, where you had those big moves in the equities and everywhere really. So just using the S&P 500, the realized vol over like a week was above 100%, which is crazy. It's absolutely mental movement. But the IV, the implied vol, undershot that, and it hit, I think, 75, 80, or I think IV was like 75, but the VIX hit 82 or something like that. So it doesn't quite, in those extreme scenarios, match realized vol, because it just gets bid down or offered down when it's that high up that people just come in to sell. But obviously now with this sort of new environment, we don't know where short vol funds got blown up. We don't know how quick that will come back, but that was behavior up until then. So our option price depends on those 5 major inputs to our model. So in this case, Black-Scholes. So underlying, strike price, carry considerations, time to expiration, and volatility. And so I think an intuitive way to look at this is that we can see that the option, the price is sensitive to each of those inputs, because you change that underlying price by a little bit, the option price will change. Strike price, once you enter the contract, can't be changed, but again, if you change the strike, it will change as well. But you change the interest rate, the dividend yield, the price will change again. Obviously, as time passes, the price changes, and we've seen that in those graphs with decay, that the sort of somewhat be able to see that behavior of time or time decay. And then also we change the volatility of our asset or the implied vol, and it spits out a different price as well. So intuitively, we can see that the option is sensitive to each of these inputs. So the way that we look at those, especially in the sort of Black-Scholes world, is by using Greeks. So the Greeks are sort of a measure of risk, and what's nice is you can take the Black-Scholes formula. So you can go, sorry, let me just go there. So you can take this formula and you can differentiate it with respect to the different parts. So with respect to volatility, with respect to time, with respect to the underlying price, with respect to rates. And you can see analytically what that price change is going to be, at least in the local sense anyway, so in the sort of immediate range. So we're just going to look at the 3 biggest risks, or the factors that change the price of an option the most. So underlying price movement, movement in volatility, and movement in time to expiration, or the passage of time. So we can look at delta here. So delta models, and it shows how much we expect our option price to change with respect to change in the underlying price. So mathematically, it's just giving you the linear slope of our P&L. So looking down here on this picture on the right, where you've got this green line, that's me trying to shoddily draw on what the linear approximation is of that delta. But we can see, of course, because we've got that convexity that we've paid for with our time decay, that this is not constant. So if you can look, it gets shallower down here as we move down. So this is in the case of a call, it gets shallow as we move down, because we're not as long, because we've got convex exposure. But then as the asset rises, we get longer, because again, that convexity. So we look over here on the left. So this is how delta changes just for a standard call option through spot price and through time. So this blue line here is showing how delta changes through spot. So you can see 100 down here, and as it moves down to 85, we've got no exposure anymore. And as it moves up to 115, we've got full exposure. It's as if we're long one future. But then we can also see this grey line here shows us 16 days in the future, or 16 days to expiration rather, how much delta we've got. So you can see that the change of our delta is a bit steeper as that time passes. And then also, if we were just to hang around, so say we came up to 103. So 103 is right around here. I'll draw that on with a pen. So 103 is right around here. So if we're here, say the underlying price doesn't move. If we waited 2 weeks, say, so it's assuming 30 days to expiration. If we waited 2 weeks, our delta would change. It would bleed upwards to 16. So that's one way that just be aware that these things aren't constant. These risk measures aren't always constant. So it's an extra thing to think about there. Yeah, okay, so my delta is changing through spot, but then also it changes through time. So you might have a guy on the weekend or on Friday, say Friday evening, he looks at his position and say, okay, I've got this delta, that's acceptable. But if he doesn't account for the bleed that takes place over the weekend, his deltas are going to be different on Monday. It's almost certain, unless you've got a bunch of at the money options where there's no bleed, that this is what his option delta is going to be. And then obviously we see this delta expiration, and we can think about that kinked payoff path as well. So because this is literally just, well, it's the differential of this price movement here. We can see that we have no exposure, no exposure, no exposure, no exposure. We hit the strike, bang, steepens up big time. And that rate of change in delta is, and I'm sure this is a word you guys have heard many times, not just from me, but on Twitter as well, that's your gamma. That's your gamma kicking in to change that option delta as it is there. So again, you've got this bleed factor, but then you've also got this curve factor here, this change of delta with respect to spot price. So now when we measure our option sensitivity to IV, this is called Vega, and measures how much your option price will change with respect to a 1 basis point move in implied vol. And so this is your Vega when you've got 30 days to expiration and you're right at the money. You can see it's largest, and it moves sharply away as you move either side. As you move away from the money, it just kind of falls away quite quickly. But then you can also see, again, because these things are sensitive to time, so these measures are sensitive to time, like Vega and Delta. As time passes, you get shorter, well, you don't get as long Vega, and if you're short, likewise, you're not quite as short. So really the reason behind that is that if you think back to that final payoff of an option, there's no volatility term. It's literally just stock price minus strike price for the call, or strike price minus stock price for the put. So this exposure to volatility, when you take it right down to expiration, doesn't matter. It really just matters what the price you paid for the option is. But over the course of the option's life, there is this sort of interim mark-to-market P&L that arises from the change in implied vol. And this, as you'll see in the next slide where we look at theta, which is time decay, is an important factor to cite in showing how much decay you're going to have, because it doesn't matter at the end. There's no volatility term. All it matters for is during the life of that option, what will my P&L change like if IV changes, because IV does change. And this Vega is like the useless Greek. If you were to look at the original Black-Scholes paper, because the assumption is there's constant volatility, Vega P&L should never arise. It should always be constant, so it shouldn't matter, but it does. And so, yeah, so it's only important, key to remember, it's only important for mark-to-market P&L. And I should say, if you buy the option, you're long Vega, and when you sell the option, you're short Vega. And just go back to this delta. When you're long a call, like we are here, you're long delta. Short a call, you're short delta. Long a put, you're short delta, and you're short a call, short a put, sorry, you're long delta as well. So just these different, just imagine the sort of directional path that you want the option to take, or do you want the asset price to take, depending on your positioning. So we can look at this time to expiry, so theta. So theta is again the big one. So theta measures the change in option price with respect to one day's passage of time. So as we've seen with Vega, it's the largest when we're at the money, but theta kind of kicks in really big time as expiration increases, because you can see here, look, so this is your theta today. You can see it falls away as you move either side of the money. But if you were to sit where you are, you suddenly find yourself shorter theta, so you're paying up more every day. So yeah, so in 2 weeks, this much short theta, but then 2 weeks further, and you're this much short theta. So if you were to graph just this change here through time, it would look like this, kind of like that, exponential, or rather, it would be negative. It would be like this, so like that. This would actually be your gamma, but yeah. So you can see that obviously theta increases as time to expiration decreases, and as you stay at the money. But it's also important to remember that theta increases as IV increases. And remember, our P&L from IV changes are measured by Vega. So, but then again, remember there's no volatility term in the final P&L. So theta increases as IV increases because you're gaining, the option is gaining value. But at the end of the day, or the end of expiration rather is a better term to use there, the option has to decay down to its intrinsic value, because it doesn't matter what the interim volatility is. It's just got to get down to this point. Sorry. So it's got to get down to. So it doesn't matter if you're here. So say you're trading here, but vol rises, so your P&L actually like hits, and you're like up here, say, but you don't move. Over time, your time decay will be larger, because at expiration, you've still got to come down to that intrinsic value here, which is nothing. Even though you're taking all this mark-to-market interim profit, it's going to get eaten away from you even quicker, because it has to, just by nature of this kind of no arb rule, that it has to decay down to its intrinsic value at expiration. That again, yeah. So theta. So we can see that it does get. I think Mike commented and said this is a funny place to put it. It gets complicated, but we can see that Greeks describe our present exposures to current risks. But as we saw and explained, those aren't constant, and they change as the underlying moves, as time passes, and of course as volatility changes, because this Vega is not constant as vol changes, this theta is not constant as vol changes, and this delta certainly isn't constant as vol changes. So if you're someone managing risk, or you're the trader, or you're whoever, you're on the desk that deals with options, you have to have quite a strong understanding of first these basic Greeks of sort of delta, Vega, theta, and rho is the other one that measures interest rate sensitivity. Then your second order Greeks, which describe the rates of change of your first order Greeks. But then you've also got to have an understanding of your third order Greeks. So the Greeks that describe the changes in the second order Greeks with respect to the different inputs. And when you take, especially if you've got a big book, that's dealing with a lot of strikes across different points of the skew, different points across the term structure, so how that looks is different points across the surface, you've got to think that there's different behaviors across each of those points. Each of those options has different individual Greeks. And even though your aggregate book might give you a set number, that number is not always realistic. So Vega, for example, is not realistic, because that net Vega is assuming a one-to-one movement across all strikes at all maturities, which just isn't the case ever. So yeah, so you've got to be aware of how your Greeks are changing with time, spot moves and as time moves, and how the Greeks that describe those Greeks change with time, spot and vol, and so on and so on and so on. But it's really these third order ones are the highest that I've seen it taken. And obviously I saw some excerpt from a Taleb book, and he's obviously up himself, and he's like, oh yeah, we used to look at fifth order Greeks, and it's like, fine. But third order Greeks is generally the highest that I've seen it get to. So yeah, so just as this isn't the actual conclusion, but just as a brief conclusion to the other stuff that we've looked at, we can see that options are really useful tools to hedge, but then also to be speculative in a market. They can give you a sort of defined risk strategy to take advantage of expected price movements, richness and cheapness in IV. So sort of skew plays is one thing that you can look at, but then also these sort of idiosyncratic opportunities involving time, because what you find is that when the derivative market on an underlying is really large, and the activities of delta hedgers, so people who want to remain delta neutral or have no directional exposure, when that flow starts to dominate in an underlying's price, and you see this, I think, in small cap stocks, especially with big derivatives markets on top of them, that they can really sort of pin a price. So you see this thing about gamma pinning a price to the stock, and I know the guys at Macro Hedged, Adam and Hugh, have covered that. But you can take advantage of a big open interest position near expiry, near the strike. When the strike with the highest OI is near the underlying, what you can do is sell a condor or a fly or a straddle around that strike. And because there's so much exposure, sometimes what you find is that those delta hedging activities are just sort of batting the price between this tighter range, because of gamma. Basically, as gamma increases, their deltas are changing a lot quicker. So they got to come in and make use to sell these deltas here, sell them there, and the price gets stuck. And you can take advantage of that. So that's what I mean by idiosyncratic opportunities involving time. But of course, no free lunch, and so they don't come without their risks and complexities against outright positions. And obviously, hidden risks are really kind of everywhere. So one example is a straddle, so short straddle. So you can sell an at the money call and at the money put, and you can see that the delta is nothing. Basically, it's minus 0.17. Basically means I've got no exposure to the underlying. But you look at your gamma, so your gamma describes the rate of change of your delta. You can see that my gamma position is showing that my delta is going to move, in this case unfavorably. Because remember what I said about convexity? It's a positive second derivative. This gamma is your second derivative with respect to price, but it's negative. So I haven't got convexity on my side. What's going to happen is, as the price moves down, this delta is going to, be positive first of all, and make these deltas bigger and bigger and bigger. So I get longer as I go down. Likewise, if it goes up, this delta is negative. So I get shorter and shorter and shorter. And so P&L moves the wrong way, right? So that's just what I was explaining there. You get long as you go down, and short if you go up. So it's a bad situation to be in. But of course, you're getting compensated for that with time decay. So because you're selling that convexity. So this was actually, I took this, I think, on the Tuesday night of the election. And I think the straddle vol was, right around 50. And I thought, this is stupidly high. But I thought, what would it look like to sell that? So this is the P&L curve. You can see that it looks bad if I go a big move either way. And it's not so bad if you just kind of stick around. So over the course of 3 days, I think you just about lost money because we were in like 3,500s. But you would have made money in the following 2 days with the vol crush and the time passing. So you can see as time passes, you just take out, so down here in 1 day, you take out a big chunk of that P&L. As another day passes, another big chunk, and then you probably wouldn't hold to expiration, but you can see a big chunk of that P&L can get taken out. And the next morning, when I gave this presentation to another bunch of people, this is how it looked 15 minutes before I did it. So the vol actually didn't move that much. It came down a little bit. Time obviously passed. Spot did move, but not massively. And so you gain some profit. So how this looked here was this difference of 6.13 times by the contract multiplier of $50 per tick move would given you a profit of 300 quid. So it would have been a nice way to start your Wednesday morning. So just looking at the risk and reward of that player, why you would play it, because obviously it looks a bit sort of dangerous on the face of it. So you're short gamma, so it gives you the wrong deltas basically. You're long when the market goes down, and you're short when the market goes up. And this is the curve of delta, remember. So as the market comes down here, because left is down in price, you become delta 1, so long a contract, but then you become short as you rise. So you're shorter contract as the price goes up. But you are getting paid an obscene amount of theta. So you're getting paid, I mean, this is indicating with like one day to go, £1,000 or $1,000 of theta per day, which is quite a lot. But you are taking on that increased gamma risk where your deltas can flip to the wrong way very, very quickly. So risk and reward and payoffs, and it just depends on your expectation. But no free lunches in this game, even though I'd say the freest lunch is having that defined risk, because over and above outright positions, you know what you can lose, and you do know what you can gain if you structure a trade correctly, like a call spread where you buy one call and you sell a call above it. You know what your P&L is going to look like. So yeah, so that is the presentation. I hope you guys found that useful. Yeah, I'd love to hear and answer any questions if you guys have got them. Cheers.
Hey, Jamie.
You all right?
Yeah, so if you do a long call and a short putt, that's, if I get my head around this right, that's the same as doing having a long position in that stock, right?
It is, yeah. And actually, I can show you that if I go back on screen share.
I couldn't get my head around it. I was trying to figure it out the other day.
Yeah, no, that's exactly what that is. And this is actually that concept of, it's called put call parity. So this is the spread builder tool. Can everyone see the screen?
Yep.
Yeah? Okay, cool. So this is basically design a spread, and you can put it in and see how it looks. So if we take an asset, I've got the ES here trading at, for example, 3,500. Come in, these have to be the same vol to avoid sort of arbitrage stuff. So you're long a call and shorter put at 3,500. 20 vol doesn't 132 days to expiry, doesn't matter either. This is how that looks. It's just a simple long contract. But if you would flip, yeah, exactly. You flip that around. So you're short the call, long the put, and you guessed it, short contract.
It's short. So does the implied volatility need to be the same in both contracts?
It does, exactly. So at the same strike, it's this function of no arbitrage. So you can't have a different vol, because so say, I'll just flip this back to one. So if this was, so let's say the call was trading at 18 vol, same DTE, you would basically see this, it's a slither of difference. I'll just pop that down to 2%. It's a sliver of difference. But you can see here that it adds in this time decay. And so if you were to come in and just delta hedge that position to expiry, you would pull out free money, because you're buying vol at the same strike at 18 and selling it. So you're so just arbitrage. You're buying low, selling high, instantaneously.
So you'd never find so for example, if I went in now to buy a short put and a long call, you'd never really find them at different volatilities. They'd always be the same.
No. I mean, not accounting for bid-ask spread, because obviously if there's a certain width at certain liquidity at a certain strike, and you can find that in deep in the money options. So deep in the money, so really low strike calls or really high strike puts, you find the liquidity starts to sort of wane away, and so you wouldn't be able to get that arbitrage in. But if you were the market maker, you might be able to steal some of that out. But you would be very, very, very hard pressed to come in and find a different vol for these two options.
These two, okay.
Yeah,
that makes sense.
Anything else, guys?
Last question. Unless someone else has got one, I don't know.
Yeah, go for it.
So the theoretical value.
Yeah.
How would you calculate that of an option?
So the theoretical value is just taken. So say I'll go back on the presentation. The theoretical value is just the price that Black-Scholes model is gonna. Where is it? Here. So this is just the price that the Black-Scholes model will spit out at you. So basically, okay, so I'll run through it on here. So let's say you've got an asset trading at 100, strike of 100, no interest rates, 1 year to expiration, and a 20% vol. it would look like this. So you would have 100, well, the present value of 100, so it'd just be 100 times, so with no rates, remember, times the normal distribution function against log of 1. So 1, so just do that there. So 0. I should know that really, but plus half the variance, so 0.5 times 4 1 over 0.2 times 1 square root of 1. So it would, you basically, like, you split all that into here, and 100 minus 100 times n of d2, which is slightly different to d1. But when you come in and you evaluate this function, so this would basically be this, but slightly different. It's just maths. It's just maths. You have all these equations. You put the values in those different variables, and it spits you out a price. And that price is obviously, it's in pounds and pence, or in whatever currency you're denominating in. But yeah, so that is all it is. So that's lucky. So
this is only for European options, right? Not for American.
yeah. So one of the things with American options is, so let me just, I'll show it here. So we've got, so American options, just so everyone remembers, is where you have the ability to exercise prior to expiration date. You could exercise. Okay, cool. So you're here. Let's say you were to, so let's, okay, I say we're in the same day. Vol hasn't moved. I'll just, and the underlying has moved up. So we're long a call, but the underlying's moved up 5%. So our P&L would be 5,714, and you'd be sitting here. And so you might be thinking, oh, so what would happen if I exercise this? What's it going to look like? If you exercise this here, you're at 36,750. So you have got 175 dollars of intrinsic value, right? And if you were to exercise that here, you would just have a standard long contract, long from 350 or 3,500 rather, and you would lose this convexity, lose this potential for less risk. But then you'd also be giving up, because essentially that premium goes, you've paid it, it's deducted against the credit to your account of the new long position, and then you come in here. So essentially you're getting rid of all this time decay here. So most times you find it's a lot more favorable for you not to exercise, but actually just to sell the position on, because you've still got time value left in. But if you were to exercise, you're essentially dropping this down to here. You're just allowing this to move through time that day because you're exercising, and you pull out that much profit because you're taking away that premium. So that would be, so there is in theory a different price, and there is a different set of conditions that you'd be looking to exercise against. The only one that I can think of off the top of my head is a deep in the money American put with a lot of dividends. I think that is the one exception. I think that's the one exception to where you should exercise. And it's funny actually, because even though you're long the option, because of the carry, it actually pays for you to hold on to. So you get long theta, so you get paid theta to hold on to that option. So it's very rare that you'd ever want to give up that convexity. You're better off just selling it on. But of course you can go in and exercise, but it would be the wrong decision to do so. You get more money from just selling on that market, that option. I hope that made sense. I don't know if I went a bit weird with that.
No. I think I'm following. Yeah, it was good. Yeah? Thanks.
Cool. Okay. Is there anyone else with questions? Obviously, really happy to answer them. No? Well, if that's it, then yeah, I don't mind calling it a day here. We can all go home. Cool.
Cheers. Thanks very much, Jamie. Appreciate it.
Cheers, mate. That was informative.
I'll stick the recording into the chat so we can all see. But yeah, thanks guys.
Cheers.
Cheers.